All right, welcome back. This is module 2 of the speed banking class. In this module, we're going to be talking about debt payoff. Now, my intention with this module is we're going to take kind of some average American numbers that I just kind of pulled out of a hat, and we're gonna talk about how the average American currently does it, and then we're going to talk about the principles of speed banking. We're going to apply those to the average American model, and we're going to see the change that makes. So let's go ahead and dive in now. As usual with most of these courses, I have to share a disclosure at the beginning. I am not a licensed attorney, accountant, financial advisor, broker, agent, or any other licensed individual. I'm just a student, just like you. I have a fascination with financial strategies, with investing strategies, and I have learned a lot over the last almost decade of being a real estate investor, and I just want to share those things with you, so hopefully that's okay with everybody. Make sure you seek legal and financial advice from professionals before you go and apply this to your specific situation, because this is just general information. So let's dive in. I want to talk about the average American model. Average American household brings in about $5,000 a month, and that's usually two incomes. And usually what happens is they work their job, they get paid in cash, and they take that cash down to the bank and they put it into their checking account and savings account. Now, I want you to stop and think about that for a second. Have you ever asked yourself why checking and savings? Most people just do it because that's what mom and dad did, or because that's what the bank said to do. But remember, that's so important to remember throughout this entire class, that the bank is a business, not a nonprofit organization. Its primary goal is not to help you. Its primary goal is to make money on you. So it's going to tell you to do the things. The bank is going to tell you to do the things that will make the bank the most money. So with checking and savings, I don't like checking and savings for a number of reasons that we're going to dig really, really deeply into throughout this course. But for the sake of this module, the main reason I don't like it is because banking law defines checking and savings accounts as something called deposit accounts. Now, the banking law allows the bank to use the money in its deposit accounts to go out and extend loans to other customers and invest in other markets in order to make the bank more money. So basically, the bank's just using your money while it's in there because they can. So they're going to encourage you to put your money in there so that they can use it. There's way more benefits to the bank by you using a deposit account than there are benefits to you. However, this is what the average American does. And the other reason I don't like deposit accounts is because it causes that cash segmentation that I talked about. So we bring the money in, we put it in a central location, and then we start splitting up the pie every single month in order to pay our bills. But the problem is, because we have these bills that are spread out, it causes us to just slice off little portions of the pie, usually minimum payments, and push those out. And by the time we're done paying those bills, most people are left with almost nothing. Now, before we get too far into this, I want to stop here for a second. So you see these minimum payments that we made. Everything you know about banking comes from the bank. Everything you think you know about banking comes from the bank, and that's that the bank has a specific psychology, a specific way they want you to think about their products. So that's true from checking accounts to types of loans to types of lines of credit to credit cards. And I bring that up because most people don't like credit cards. And that's actually something that the bank wants you to feel. And there's reasons for it that are going to become apparent in this module. But the bank tells you, with one hand, they tell you, hey, don't use credit cards. They're scary. They'll hurt you. And then with the other hand, they'll send you offers in the mail. We've all gotten the offers in the mail for the credit cards. They want us to sign up for them, and yet we're told that they're scary and that we shouldn't use them. So I want to kind of set up two different scenarios here to show you why they do exactly that. So the first scenario is you get this $15,000 limit card, and you want to throw a big old Super Bowl party, and so you go down to your big box store and you buy the big screen TV and the sound system and the microwave and the popcorn maker and all this stuff. It comes to $12,000. You take the stuff home, you set it up, you throw your Super Bowl party, your team wins, awesome. The next day, Monday, rolls around and you log in and pay off the balance completely. So the bank only held that debt for maybe 2 days, maybe a little less. Does the bank make money when you behave like that? The answer is no. They want to be holding your debt for long periods of time, because then they can collect more interest. If you're only going to have a debt with them for 1 or 2 days, they don't like that very much, because they make next to zero on your on that debt that they carried for you. So they want you to stretch it out. So what they say is, hey, look, it's scary, don't use it, but they want you to still sign up for it, right? And that causes us to get credit cards, maybe put it in the safe and not use it. And then when that moment of desperation comes up, maybe, we've all been at that point in our lives where there's more month left than money, where the checking account's at zero, and you got bills that are due, and you're not going to get paid for another week. And you start to freak out. The cold sweats set in, the fear sets in. The tingles down the spine. You think, what are we going to do? We got bills to pay. We got mouths to feed. The creditors are already calling, asking for payments. Let's just move to Canada. They'll never find us there, right? Or we could sell one of the kids and that get us by for a week. Hey, wait a second. We've got that credit card in the safe that we signed up for but never used. We're desperate right now, so let's pull it out and use it. So you pull the credit card out of the safe and you swipe a little bit for gas because you're desperate. You swipe a little bit for groceries because you're desperate. You end up buying the big screen TV because wife's not looking and you're desperate. What do you do? But before you know it, you've racked up $12,000 worth of desperate on that credit card. And when you're desperate, you can't afford to pay it off the next day. So what you do is you stretch that puppy out as far as it'll go, and you pay the minimum payments every single month for, on average, about 7 years. Now, does the bank make money when you behave that way? Absolutely they do, and that's how they want you to behave. That's why they've created the psychology that they've created around credit cards and lines of credit. So they tell you pay the minimums on everything, budget for your lifestyle, and with what's left over, create savings account. You use the accumulation strategies that we've talked about. Now, I don't like accumulation strategies because basically they're just places to stuff money where it's not really going to do very much while you're not using it, but it's there for for quote unquote emergencies or for a purpose. Some examples of the savings accounts that I'm talking about will be your 401ks and your IRAs, at least the way that we were taught to use them in traditional schooling. Your savings account, obviously a deposit account. Of course they want you to put money there. The money that you stuff in the mattress for a rainy day. The account that you put money into to save up for a vacation. Those are the types of savings that I'm talking about here. So what happens is you have $5,000 in, $5,000 out, which puts you at a cash flow of zero. Now, here's the thing. I said this in the last module. Cash flow is king. The wealthy will look at cash flow before they'll look at anything else. And a model where the cash flow is zero is not interesting, right? The employee mindset individual will look at what they're bringing in, $5,000 in this case, but the wealthy will look at cash flow. They don't necessarily care what's coming in. What they care about is the cash flow. What can I take and reinvest, right? So they don't really like this model because of that reason. I don't like this model because of that reason. So I want to talk a little bit more about some of the stuff that's on the screen here. Now, let's run a little experiment. Let's say that you owe me some money. You borrowed some money from me, and I said, absolutely, you can borrow some money, but we're going to do this right. While you have that money out, you're going to pay me an interest rate. But I'm a nice guy. I'm going to let you pick your interest rate. Here's the rules. You have to pick an interest rate that's on the screen. So on the left, you see we have 21%. On the right, you see we have a couple of 6%. So your choice is between, you can pay me either 21% interest or 6% interest. So most of you are probably thinking that you're going to want to pay me 6% interest because it's a lower number. Well, I'm going to prove my point with another analogy. If I told you that 32 degrees was the freezing point of fresh water at sea level, is that a true statement? My guess is that the majority of people would say yes, 32 degrees is the freezing point of fresh water at sea level. Well, I left something out. 32 degrees Celsius. Oh, wait, can I change my answer? What I did there is I did not disclose the unit of measure that I was using. So if I were to be more specific and say 32 degrees Fahrenheit and 0 degrees Celsius are the freezing point of fresh water, well, we all know that that's a true statement. But what happens if I do this? What happens if I take that 0 degrees Celsius and I raise it by 1 degree? So now we've got 32 degrees Fahrenheit and 1 degree Celsius. Which one's hotter? You're saying one is hotter than 32? How could one be hotter than 32? It's a lower number. Oh, it's the system that we're using. It's the unit of measure that we're using that makes the difference. Well, guess what? That's what the bank's doing to us. See, these interest rates, they don't necessarily tell us how they're calculating that interest in their advertising. And so your average person looks at this and says, well, I'd rather pay the lower number, right? But here's the problem with that. Let's dive in and let's learn little bit about the difference between lines and loans. So anything called a loan by definition is one directional and amortized. One directional meaning you're gonna take out that loan once, and then your relationship with it is that you pay the loan, you make your payment, and that's it. You can't take money back out unless you refinance, but you can't take money back out of that loan. You're just going to make a payment until it's paid off, and that's the extent of your relationship. It's a one-way relationship. Anything called a line, by definition, is one directional, is simple interest and revolving. So loans are one directional and amortized. Lines are simple interest and revolving. Revolving, basically that means that imagine if you've got a maxed out credit card and you make a payment on that credit card, it's going to open up a little bit of room. Now that room, we call that leverage. Remember that word? That's the room on your line of credit that you have available to spend still. We call that leverage. You can take that leverage that you've created by just simply making your payment down to the gas station in the form of your little piece of plastic, swipe your card, and buy gas with the money from the payment that you just made. So it's a revolving nature in that account. Now, I always get questions on amortization. People will say to me, I have home loans and I've got car loans and student loans, but I've never heard of this amortization thing before. What is that? Well, let's talk about amortization for a second. We're just going to use the example of that house that we had on the right side of the screen before. A $200,000 house at a 6% interest rate on a 30-year mortgage is going to be about $1,200 a month in a payment. So let's say you buy this house, you get a mortgage on it, you move your family into it, you make your first payment of $1,200, and you get your statement back in the mail. And that statement says, thank you so much for making your payment. Here's how we allocated it. Your $1,200 was split up into $250 that went to principal and $950 that went to interest. And you're scratching your head thinking, what the heck? I thought this was a 6% loan. I'm so confused. And so you call the mortgage company and you're getting all upset and they say, wait a second. If you look at the amortization table here, it crisscrosses about halfway through. And at the very end of the loan on payment 360, 30 years from now, you'll make your $1,200 payment and $950 of it will go to principal and $250 of it will go to interest. So, it evens out. And you say, oh, whew, I thought you were ripping me off for a second. So glad. But I don't like this strategy because Americans don't behave this way. There's not very many of us that actually go 30 years on a single loan paying the minimum payment every time. And if you did, you'd end up paying more than double what you borrowed because of the length of that loan and because of the amortization. So it's not a good deal any way around. But what most Americans are doing is they're refinancing their loans about a quarter of the way through. So on a 30-year mortgage, about 7 years in, most Americans are refinancing, which means that when you refinance or get into a new loan, it puts you back at the beginning of the amortization table, which means most Americans are paying mostly interest all the time. So that's kind of a scary thing to think about. The bank's capitalizing on this refinancing thing. They're pushing you back to the beginning. They'll even call you. You may have thought that your bank was being awful nice to you when they called you and said, hey, we've got an opportunity to lower your payment. Why don't you pay us less? Well, if you really stop and think about it, why on earth would they do that? They're a business. They want to make as much money as they can. Why would they call me and tell me to lower my payment and spend resources doing that? Pay someone, to call me on the phone. And the answer is they wouldn't do it unless there was a benefit for them. And here's the benefit. As you can see with this red line on the screen, the further along we get in the timeline, the less and less that they can collect in interest from your payment. So they would rather put you back at the beginning where they can collect a higher percentage of your overall payment as interest, even if that payment is slightly lower than it was before. They're still going to make more money. That's why they do it. So let's just take a little 4-year snapshot here of this very mortgage. 48 payments of $1,200 a month comes out to be, and that's on a 4-year timeline. That's 48 months. So 48 payments of $1,200 a month is about $57,000 that you'll pay towards this mortgage. Well, of that $57,000, your debt only decreases by $12,000. So you pay $57,000. They'll decrease your debt by $12,000, and the other $45,000 just goes into their pocket as interest, right? That does not look fair. So why are we doing this? Why is it that mortgages are the first thing we think of when we want to go buy real estate? And the answer is because that's what the bank wants us to think of. If you go into a bank and say, I want to buy some real estate, they're going to say, oh, you need a mortgage. Well, obviously that's the most beneficial to the bank if that's what they're recommending right out the gate. So we need to start doing some math and figuring out what are the better tools that we can use for things like buying houses, buying cars, buying education, those types of things. There are better tools. There's a better way. The bank's not going to tell us about it, and that's why I'm here doing this class. Now, let's look at this from a cash flow perspective. So remember, I told you cash flow is king. It's the most important thing. So let's look at this from a cash flow perspective. You pay $57,000 towards your mortgage over the course of 4 years. They only reduce your debt by $12,000. The rest of it goes in their pocket. But even worse than that is what it does to your cash flow. Because of the one-directional nature of loans, where you pay them and that's it. That's the end of the relationship. You pay them once a month, and that's all that you can do with a loan. Because you can't tap into that principal that you're using, that means that 100% of the principal and the interest from that payment are disappearing from your cash flow every single month. So I'm going to rephrase that question to you that I asked you earlier about interest rates. Would you rather pay me in a way where 100% of your cash flow disappears, or only 21%? Because with a lines are revolving, the principal portion of your payment you can reuse immediately. It's only the interest portion that disappears. So obviously, we'd rather only lose 21% of our cash flow, not 100% of our cash flow from the payment that we made. So with that in mind, let's talk about a couple of rules of speed banking here that we can use in order to start applying it to this model that we've set up. So rule number 1, lines are better than loans. The wealthy will focus their debt in lines over loans because of that revolving nature. It allows them to do rule number 2. Rule number 2, the wealthy, well, let's start with the employee mindset. So the employee mindset individual in rule number 2 uses cash as currency. They take their cash, they put it in a cash basis account, which has all sorts of negative stuff associated with it. You know, the deposit account stuff we talked about. You're then susceptible to cash segmentation. So not the way to do it. But the way the wealthy do it is they take all of their cash. So think about them taking their entire paycheck and throwing it at their debt. Imagine if you could take your entire paycheck and throw it at your home loan. Or take your entire paycheck every 2 weeks and throw it at your car loan or your student loan. You would pay those loans off really, really fast. But you can't because they're loans and not lines. Once you throw that money at it, you can't get it back out and you've got other bills to pay. So by using loans, we can't use these accelerated strategies that the wealthy are using. However, the wealthy know and follow rule number 1. They keep their debt in lines. That way, whenever cash comes in, they can just throw it at the lines of credit, and they use their cash as speed to pay down their debt. And then they use the leverage that creates. If you remember, we talked about how when you pay a line of credit, it opens up some room. We call that room leverage. They use the leverage that creates in the line of credit as currency to pay bills and buy stuff. Now that may sound overly simplistic, but let's go back and look at this model and see what it really does. So this family now understands the principles of speed banking. They're going to start following it. So the next check that they get, they bypass their checking account completely and throw it all at the line of credit. Now this starts doing some really cool things right out of the gate. The first thing is the bank wanted you to make a minimum payment of $600 a month to that line of credit, and you've been doing it religiously. But now you just gave them $5,000. So we've more than met that minimum requirement, and we're going to do that every single month from here on out. So you know what? We don't even need to budget for a minimum payment in that line of credit anymore. That credit card or that HELOC or whatever the line is that you're using. That virtually disappears from our budget, which means that $600 goes back to our cash flow. Also, we're going to talk about why it's so important not to use accumulation strategies whenever possible. There are other ways to plan for retirement. My favorite way is cash flow real estate. There are better ways to plan for emergencies. My favorite way is this very strategy, speed banking, which we're going to get into first in a second here. There are better ways. If your plan is to hoard money and save money in an account until you have a specific amount, there's probably a better way to do it. You just need to learn what it is. The accumulation strategy is inherently flawed. So we're not going to use that. We're not going to have to worry about our payment anymore, our minimum payment anymore in the line of credit. So that puts $2,000 a month into our cash flow. Now you'll see we still have a mortgage payment, we still have a car payment, we still got our lifestyle we got to pay for. That comes to $3,000. So we have a model of $5,000 in, $3,000 out, and $2,000 a month in cash flow. So let's graph what that does in the line of credit. We started with a $12,000 balance. We threw our whole paycheck of $5,000 in, dropping that debt, and then over the course of the month, $3,000 came back out. Well, at the end of the month, we're going to get paid again. So all we have to do is just repeat this process, and we get a net pay down in that line of credit of $2,000 a month. Now, the cool thing is because it's a line of credit, that $2,000 a month remains liquid, so that if we need to use it for emergencies or if there's an asset that comes along that we want to buy, it's available to us to use. So we have that freedom. But while we're not using it, it's not just sitting in a savings account somewhere. It's working for us. It's lowering our debt, thereby lowering the total amount of interest that we're paying. So I made the math really easy on this one. $12,000 in debt divided by $2,000 a month in cash flow means that we pay this off in 6 months. Now, minimum payment, the average payoff for a credit card with that minimum payment is 7 years. So what was going to take us 7 years making that minimum payment now takes us 6 months without getting a raise at the job and without changing the lifestyle. So this is an incredible strategy. I'm sure you can already start to see some of the incredible attributes of using this strategy. So let's dig in even further. By the time you get down to zero here, the bank looks at you. They say, "Man, you're really good at this debt pay down thing. You've used a lot of it. You've paid even more of it off. Your credit score has gone through the roof. We're going to give you a credit limit increase." Now, here's the cool thing. As wealthy mindset individuals, we know that we can use our lines of credit for assets or emergencies. So they just added 10 grand to your emergency fund. And when, I think of the last time the bank called you and says, "Hey, you're using your savings account like a champion. Here's 10 grand for your savings account." Not going to happen, right? But when we behave like this, we get those types of benefits. Now, very important, and I'm going to emphasize the assets and emergencies. That's it. That's all that line of credit, that room in that line of credit is allowed to be used for if you're going to do this strategy right. Where the employee mindset gets it wrong is they use their lines of credit for liabilities. They use it to buy hot tubs and TVs and four-wheelers and all sorts of stuff. That's not what it's for. It's for assets, things that make you money on a monthly basis like rental properties, or it's also your emergency account. Okay, so keep that in mind. Very important. Again, back to the matchstick example. It's a tool, right? It's not, debt isn't inherently good or bad. It's a tool that we can use, and how we use it is what is good or bad about it. So now we've paid off this credit card completely, and we've got these loans over here, these really expensive 100% cash flow loans over there that we need to start moving the debt over the lines of credit so we can keep doing speed banking with it. Well, one of my favorite tools to do that are those little checks, those balance transfer checks that the credit card companies will give you. And whatever the amount was that you paid off in the line of credit before, in this example, we used $12,000. Write that amount on the check, $12,000, write principal only, and address it to, in this case, we'll pick the mortgage. Address it to the mortgage company. Send it off. The mortgage company gets it, and they see, oh, you paid an extra $12,000 towards your house. So you log on and you see on your statement that, yep, sure enough, your mortgage balance dropped by $12,000. For the bank, it was same as cash. For the mortgage company, it was same as cash. But all you did was move that over into your line so that you can use speed banking to pay it off. So now we've moved $12,000 worth of mortgage principal over to the line of credit, and we do the same thing we did before and pay it off in 6 months. Now, here's the thing about that. If you remember, when we go back a few slides back to our little our 4-year snapshot, our 48-month snapshot, if you remember, we gave the bank $57,000, which only reduced our debt by that 12 grand. And it took us 4 years to do that. Well, moving that 12 grand over to the line of credit, even at 21% interest, I did the math for you here, so you can check my math if you'd like. $12,000 times 21% interest. That's annual interest. It didn't take us a full year. It only took us a half year. So I divided that by 2. That's $1,260 in interest that we'll pay, and it will only take us 6 months to pay off versus $45,000 in interest that we have to pay over 4 years to pay off $12,000 in principal on our mortgage. So you can see the difference. And based on what we were taught in traditional education, we would have never guessed this, right? But when we actually sit down and start doing the math, the difference is astronomical and could mean the difference between paying off a mortgage in 30 years or paying off a mortgage in 5 years. So as we start to understand these things, our behavior is going to change, right? And so if we can do one of these cycles every 6 months, well, then we can do 2 a year. All we have to do is just repeat that cycle till it's paid for in full. You can pay off a mortgage in as little as 5 years. So this family pays off their mortgage in 5 years using the speed banking strategy. And when we don't have a mortgage anymore, we don't have a mortgage payment anymore. So that money goes right back into the cash flow. But when we have more cash flow, we can pay off the next debt even faster. So the speed curve actually decreases and we pay off that next debt even faster. All we have left here is the car. We pay that guy off in 6 months using the same principles and strategies that we talked about before by moving that debt over into the line of credit and then using the power of our entire paycheck to pay down the debt chunks at a time. When we don't have a car loan, we don't have a car payment anymore. So that money goes back into the cash flow and we have an increased cash flow. Now you can see we are completely out of debt. And what would have normally taken an average American family 30 to 35 years to do, we just did in 6 without ever getting a raise at the job and without ever changing the lifestyle. What an incredible strategy. I'm excited in the next couple of modules to be talking and diving into the details of how and why this works and how you should start applying it. But the most important thing to remember is it's not magic, it's math. So that wraps up Module 2, the debt payoff module. In the next module, we're going to go to the next level with this. So we're going to continue with that same model that we set up, the average American model, but now they're paid off with their debt. So once we've paid off our consumer debt, then how can we use speed banking? And the answer is real estate acquisition. That's what we're going to be talking about in Module 3. I'm excited to see you over there. We'll see you on the other side.